Hello folks, Steve Lentz here with Discover Options and welcome to this edition of the Market Reports. This will be for Friday ending November 18th, getting ready for the open on Monday, November 21st. Today we have two reports for you. The S&P 500 Condor Butterfly Timing Report for those of you that sell premium neutrally using market neutrally using butters and condors. The other one is for those of you more statistically interested in what the market is likely to do. It's the S&P 500 Directional Likelihood Report. We'd love for you to subscribe to this by clicking on the button below. Additionally, we have a free ebook. You can click on the link, I think in the above right, and we'll get you in. You can just put in your information and we'll get you this free ebook by myself and Jim Graham as well. Here's the current market condition. We've had two upswing days, and then Thursday was an upswing day. Friday was an upswing day with higher highs and higher lows. All this is occurring when we're above the 50-day simple moving average. And then, as part of this market condition, we have price action and trend. We also have stochastics that we look at. And right now we're at about 95. So let's just define our market condition as being between 70 and 99. And we're above the 3-day simple moving average, or the %K. So all that leads to a definition of a market condition, folks, that has occurred roughly 93, 94 times between now and going back to maybe January of 2000. Okay, and so that's important to know, because that's kind of what we do here is we look at this current market condition and we go back and examine, well, what happened in the past, and we do that for both of the reports. So first we'll look at the Condor and Butterfly Timing Report. We'll get into the details later, but just as an overview for those of you that are consistent watchers of this weekly program, right now it's pretty much a wash in terms of condors and butterflies appropriateness right now. There's a slight selling edge of not even 1%. And so when you look at this, this condition has occurred 94 times in the past, and of those 94 times, almost 66% of those bars work out to be favorable for selling premium through butters and condors. And that's about the same as it is, roughly when you look at the baseline number of favorable bars, it's roughly 65%. So we have less than 1% of an extra edge based upon this market condition, which is not really anything to write home about. But still, if you have a viable approach and you're able to adjust and move with the markets, you have a baseline edge anyway trading the SPX because it's chronically overvalued. So statistically we say it's more likely than usual, or slightly more likely than usual, that Friday's bar will end up being favorable for market neutral premium selling, as you can see there. The other report we'll get to is the market likelihood report, and just as an overview, what you're seeing here is you're seeing a lot of red numbers, meaning that we have many of the bands, or all the bands in this case, are being struck less often after our current market condition than normal. And so this is a picture of lower market volatility. If you study the numbers more carefully, you'll see that the upper bands are struck typically less often. Out of these 93, the upper bands are struck typically less often at a greater degree than the lower bands. Okay, so this is kind of leaning on the bearish side, but still this is a picture of lower market volatility and a picture of an edge for selling premium neutrally in that sense through butters and condors. Okay, and when we define the bands using skew adjusted VIX, it's the same kind of picture, certainly lower numbers across the board, with the bullish bands getting hit less often to a greater degree than the bearish band. So this is a picture more of a bearishness, but all in all, lower market volatility. There's a likelihood for lower market volatility, as you can see here. So that's the overview. Let's get into the details of both reports. I repeat myself every week for those of you new, but that's the overview for those of you that are veterans of this show, and we'll move on, okay? The Condor Butterfly Timing Report is very important for those of you doing butters and condors. We're going to go over why, we'll go over the methodology, and then we'll take a more detailed look at the current condition and the edge level. Why would you look at this report? Well, here's an example going back from December 31st where the market was beginning to chop around. You can kind of see at that point you may have wanted to jump in, but when you run it through the algorithm that we do, we would have discovered that there was a negative edge to doing butters and condors. Now, what did that mean at the time? That meant that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. That's not a good scenario for doing butters and condors. Okay, we want the market to be less volatile instead of more volatile. So that's how we interpret the negative edge from that respect. Okay, and in that particular case, December 31st in 2015, the market took off to the downside. And it's a cherry-picked example. We understand how that works, but it does bring the point home. Here's our current market condition. Again, we've had 2 upswing days. We're above the 50-day moving average, and in the stochastics, we're between 70 and 99. We're above the moving average, although not by very much. But that makes for a current market condition that, as I said, has been repeated going back about 93, 94 times. Here's the question on the table for the Butter Condor report. Is this condition a good one for selling premium? That's what the report seeks to answer. Is this good for selling premium through range trading, butters and condors? So here's our methodology here. First, we're going to observe how much the market actually moves from a given close. We call that actual volatility. Then we observe how much of a market move is predicted by the option prices. And we call that implied volatility. All right, the volatility implied by the option prices. Okay, then we are going to compare the two and then label certain bars either favorable or unfavorable for selling premium through range trading. So here's how we do this. First, let's go to actual volatility. We're going to look at the actual move over a 21-day period. So let's take a close. We go forward 21 bars and look at how far the market moved at the extreme, either up or down. In this case, we can see the market moved down far more than it moved up, but it moved down how far? When you pencil it out, it was about a 2.4% move to the downside. That's the maximum amount that it moved either up or down. Here's the question though, and we can label it. You can see the indicator down there. At the time, what market move was being implied by the option prices? So we have actual volatility, we have the actual move. What was the implied move? And when we go back and look at the VIX, all right, the volatility implied by the option prices, okay, we run it through a little formula. The move being implied at the time was about a 4.4% move, which is much greater than what actually took place. So in that sense, we would label that particular bar, April 28th or so, we would label that having been a favorable bar for selling premium through butters and condors, because we were selling premium and that we were selling an option price, the time premium, was implying a 4.4% move, but what actually took place was much less. So we're going to label that bar favorable. We're going to paint it blue and note that it was favorable. And what we do is we go back in time, and in hindsight, we're going to label all those types of bars blue. The bars where the market ended up moving more than what was being implied, we're going to paint those red and label those unfavorable. All right, so once we have that figured out, now notice on the right, the last 21 bars, we don't know if those are going to turn out to be favorable or unfavorable. We have to wait 21 bars first, right? So we're always looking at this in hindsight 21 bars ago. But we're going to go back in time to Jan of 2000 and examine a few things. We're going to examine what percentage of all the bars going back, we're going to examine what percentage of those were favorable. Okay? Then at that point, once we have that baseline, then we're going to look at the bars that match our current condition, all 94 of them, and we're going to examine what percentage of those were historically favorable for selling premium. Look, if we go back, and of those 93, 94, all right, that match our current market condition, if we discover that all of them turned out to have been unfavorable, well, we're going to not do butters and condors, right? If we, on the other hand, find out that all of them were favorable, all of them ended up being blue bars, well, then we're going to aggressively do butters and condors. So that's where we're headed here. We're trying to find that edge, that difference, either positive edge or negative edge. So when we go back and look at all of the closes going back, all 4,220 closes since Jan of 2000, we discovered that 65.2% ended up being favorable. 65.2. Then we're going to look at the bars that match our current condition. You could see that there's two other ones besides Friday's that are listed here. Of those bars, what percentage were historically favorable for selling premium? 65.9. Not much of a difference. There's only about a 0.7% edge to selling premium here through butters and condors. Not a big deal. But at least you know that there's not a negative edge. Okay, so I hope that's good information for you as a butter and condor trader. That's where we're at the moment, and we'll be back next week with the same kind of report, of course. Okay, now let's go to the likelihood report. Before I do, I want to make sure you understand at Discover Options we have a fantastic curriculum to help you go from beginner to intermediate to an advanced trader capable of managing other people's money. We have money managers that have come to us for help. We've given them some great insight. We have professional option traders from the floor who are now helping others learn this craft of trading options at a high level. Okay, go and check out our website at DiscoverOptions.com. We don't have classes with a bunch of people looking over your shoulder. We only focus on the one-on-one experience so that you can have someone experienced holding your hand, getting you up to a strong level so that you can really do well in this business. Okay. All right, the likelihood report. Here it is, lots of red numbers. We're going to dive into the methodology here, of course. Make sure you understand this. Here we go. Here's the current condition, and here's the question on the table regarding our current market condition. Since Jan of 2000, how often has this same condition occurred? We know about 93, 94. What did the market do in terms of direction and volatility? We're not looking at favorable, unfavorable here. We just want to know, did the market end up going up, down, wobbling around, staying in the middle? Okay, so that's what we're looking for here, is what did it do? And what we do, how do we do this, is we do it through a distribution model. We're going to first seek to understand a baseline distribution of price. Baseline distribution of price. Then we're going to look at our current market condition, and of those 94 times that it happened in the past, we want to know how the price was distributed for each of those 93 or 94. Okay, now look, if we go back and discover that all 94 experiences, resulted in the market moving upward, and there's a strong bias to the upside, well, we're going to definitely be interested in bullish strategies. If we discover instead that out of those 94, almost all of them went down, resulted in a price distribution to the downside, we're going to be very interested in bearish strategies. But how do we determine distribution? I'm going to show you that in a bit. And again, we're just looking for the differences between the baseline and then how it works out through our condition. Now, here's how we deal with distribution. I set up volatility bands around each bar's close. Those bands are set 5, 10, and 15 days away. And I use a 20-day statistical volatility, log normally distributed, so that I have 6 bands, 3 to the upside, 3 to the downside. Okay, now here's just an example of 10-day band set from the close on this particular example day. And what we do then is we go up and we ask ourselves over the following 10 days, is price going to go up and hit the upper band, go down and hit the lower band in the next 10 days, or kind of fail to hit either one of them? So what in this particular case, what happened? And in this case, the market definitely went up and hit the upper band. And so for that particular close, we record that it hit the upper band. Now, we have this close here. We have the upper band up here, and then the lower band down here. And the question, of course, what happened? Did the market hit the upper band, the lower band, or wobble in the middle and do nothing? So in this case, If you look carefully, you'll see that the market tried to go down and hit the lower band, but it failed to. So in this particular case, it hit neither band. So what we do then in determining historical distribution is from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. And we would do that on a percentage basis, so that here you go. Okay, from Jan of 2000 through November 18th, 2016. Okay, 17 years of data, 4,220 closes. You'll see that price hit the upper 5-day band 29.3% of the time. You see that? The upper 10-day band, 23%. The upper 15-day band, about 23%. The lower 5-day band, 29.7%. The lower 10-day band, 29.5%. Lower 15, 32.3%. That is the baseline distribution of price for that time span over the last 4,220 closes. Okay, that's the baseline. Now, what we're going to do is now look at the distribution after our condition develops. So there you go. You can see here, other than the Friday's experience, we've had 4 dating back to February of this year. And for each of those going back, all 94 going back to Jan of 2000, we're going to look at the distribution on the bands, etc. as of the close. We're going to examine the distribution of those instances where we had this condition and then the next day the market ended up going above, like say, Friday's high and then below Friday's low. That way, when Monday comes and goes, you'll have an idea on the different distribution levels based upon the past, if the market penetrates Friday's high or goes down below Friday's low. That'll give you a more refined feel for what the likelihoods are. Got it? Okay, so here we go. As of Friday's close, we can see that in this case, let me just show you. Here's the benchmark at the upper 5-day band at 29.3. Of the 93 experiences we had with our current market condition, price struck the upper 5-day band 15.1% of the time. That's far less often than the baseline, 14.3% difference. So this is a picture of lower market volatility, especially to the upside. Look at these other differences. Okay, 10% lower, 7.5% lower. On the lower bands, 9.3% lower, over 5.5% lower, 5.5% lower. So this is a picture of lower market volatility, but we note that the lower bands are certainly struck less often, but not to the extent that the upper bands are being struck less often. So this is kind of a slight bearish bias. All in all, a picture of lower market volatility in total, though. Lower market volatility in total. Now, what if price exceeds the upper Friday's upper price or high price? If it exceeds Friday's high, okay, we have then even more of a disparity in the upper bands, greater to 21% difference. Look at that. And then the lower bands get struck less often, but certainly far less to the degree that the upper bands get. So we're already in an overbought condition. If Monday it exceeds Friday's high, we're even more overbought, and it's less likely, to a greater degree, the price will continue up to the upside. That's what this picture represents. If price exceeds the low, still you have the upper bands getting struck less often. Definitely a bias to the bearish side, but all in all, lower market volatility. Now, one thing I like to do is recast the bands using a skew-adjusted VIX level, meaning that because the out-of-the-money calls have lower implied volatility than the out-of-the-money puts, we're going to use a lower volatility level for the upper bands than we use for the lower bands. Lower bands, 5, 10, and 15 on the downside, will have a higher volatility. Those will be set apart on the downside more. It's skewed in that sense. And so when we recast the bands that way, because VIX is higher than statistical volatility, all in all, you're going to see that the bands get hit less often in general up here, on the baseline. But still, this is a picture of lower market volatility, as you can see. Across the board, except for these two incidences, you have red numbers across, with the upper bands getting hit far less often than the the differences here are much greater than on the lower bands. Okie dokie. So same picture, just kind of you have a different set of numbers. Now here is the skew adjusted VIX to the upside and the downside. That's statistical volatility. Let's take this number, and I'm just going to give you a trading idea. If you're concerned about the downside and you have to really sell premium, maybe you're in a position where you really want to be in the market anyway, even though there's not a huge, well, we kind of have, the likelihood report showed a much greater advantage to selling premium neutrally than what was shown in the first report, which is just a slight benefit or slight edge documented there. So let me click here, click here. Let's just take a look at a broken wing put butterfly that's been delta adjusted to be as neutral as we can get it. Here's what we do. I'm going to input that 14.5 to in OptionView's SV box to get the definition of a 1 standard deviation level. And what we're going to do is structure this put butterfly such that there is, let's see, 30 points, okay, from the long to the two shorts. And then we're going to have to go out 40 points, well, let's see, about 60 points to get to this one down here. Now, when you do it this way, okay, the delta is about as close to zero as possible. And if you'll note, we have a cash flow that's positive, meaning that if the market goes up, we'll still have a cash flow coming in no matter how far the market goes up. Here's the graphic analysis of it. And what's nice here is that this is 18 days out using those weekly 4 options. But if the market over 18 days ends up going down, look at that, you get some real strong returns. Less to the upside, but still nothing to shake a stick at in 18 days. Of course, if the market really gets volatile and goes more than a standard deviation down, well, that's where you can get into some trouble here, and you'd want to certainly adjust or get out at that point. But on the upside, there's no worries no matter how far it goes up to the upside. You see that? So that's just something for you to consider. If you really have to be in the market and you want to have some concern for the downside taken care of, you can get a little more returns on the downside if it stays within that standard deviation move there. Okay? Thanks, folks, for joining us. I'm Steve Lentz with Discover Options. Good luck trading this week. We'll be back next week. Same bad time, same bad channel. Thank you. Bye-bye.